Hello, everybody. Welcome to our 2026 Outlook and Positioning video. It's hard to believe it's already 2026, but we're excited to be with you again. We had a really great 2025 in a lot of ways. We're going to touch on in this video what we experienced in 2025 from a both economic and a market perspective, and then we're going to talk about our outlook and positioning for 2026. So I'm joined today again by my friend and colleague Mike Allison. Hey, Mike, how are you? Happy New
Great.
Year.
Happy New Year to you, Derek. Great to be here.
So let's start with just where returns came in for the year, and then Mike, I definitely want to invite you to kind of comment on things that you saw in the market as we went through 2025. But probably the most important thing to note was none of this happened in a straight line last year. There were a lot of things that, if you remember back to April and Liberation Day and tariff announcements, that led to a lot of um, consternation in markets. There have been things like inflation, interest rate policy that continues to be a concern. We went through a government shutdown. We've seen
The longest one ever.
the longest one. We've seen advancements in AI. We've seen big ramp ups in AI spending. So there's lots and lots of things that we can talk about that influence the market. But at the end of the day, we had another good year in market. So we've gone, as you can see here, we've kind of strung together three good years in the S&P 500 following 2022. If you remember, that was the year where interest rates and inflation really spiked up following the pandemic. So there was a broad decline in lots of different asset classes this year. That year, you see a lot of red. But subsequent to that, we've been in, I think, a pretty sustained bull market where the S&P 500 has gained solidly double digits, close to 20% or more in 2024 and 2023. We did about 18% last year. I think what encouraged me mostly this year versus 2024 and 2023 is we saw a lot of elements of the portfolio outside of large US companies and outside of technology stocks do well for a variety of reasons. So, for example, foreign companies, foreign and emerging market stocks, so if these are places like Europe and Japan and the developed markets or in emerging markets, it would be places like Brazil and China and parts of Europe and Mexico. Those did very, very well. Many of our clients have significant foreign stock exposure, and they have for a while. This year, that really paid off for a handful of reasons. Other asset types like small companies, didn't do as well as the S&P 500. They tend to be more economically sensitive, but still produced a nice kind of mid-teens or mid double-digit return. And then even bonds had an okay year, up about 7%. So broadly, just generally good things in the market. But Mike, what were some of your big takeaways that you observed last year from a macro perspective and from managing client portfolios?
I would say, a couple things. Number one, I think the bond market did better than okay. It feels okay in the context of an equity market that was up almost 18%, the S&P 500. But, bonds had a pretty good year by historical standards, which was healthy to see as inflation has come down and interest rates, at least short-term interest rates have come down. And so bonds benefited from that. And the equity market, particularly the S&P 500, was a reminder that it's important to stay invested because at one point the market was down 20% peak to trough in earlier in the year and then rebounded and was up up nearly 18% for the year. I think also it's helpful to sort of zoom out. I know we talked about the last 3 years following 2022, but I think you could zoom out a little further and go back to the COVID period of 2020 when the S&P 500 was up 18%, and then 2021 was up more than that, significantly. So if you string together the years of 2020 through what we contemplate as 2026, it's been an extraordinary period of a market cycle. And, market cycles historically run about 7 years or so. So we think about what could 2026 look like, and we could still have a very healthy or have had a very healthy equity market cycle. And so my expectation for 2026 is some moderation. But
Mhm.
but then I think the non-US parts of the portfolios, as you mentioned, did quite well, and a lot of that was driven by a weaker dollar. And although we could see the dollar bounce at some point because it's from an oversold perspective, but I do think that there's some structural reasons why the dollar could continue to be weak, and that would benefit from non-US in allocations, which we have.
Yep. The other, before we go into 2026, the other allocation that we have for a lot of clients has been incorporating things like precious metals and commodities. And that was another good source of confirmation, another kind of good win in 2025 as we saw that part of the ecosystem do well too. I think it's largely been driven by, at least on the industrial kind of commodities, industrial metals and agriculture, that's been driven more so by a kind of growing economy, which is largely led by increased infrastructure spending on artificial intelligence. So things like copper wiring obviously is a heavy input into kind of building electronics and data centers. That's done very well. Gold has done very, very well in 2025. We have some positions, kind of quasi positions in gold and in most client portfolios, and that's really benefited. I think that's been, to me, it's harder to get a handle on what drives the price of gold, but to me, that's a reflection of maybe some increased kind of geopolitical tensions in around the globe, whether it be kind of U.S., China, Russia, Ukraine, Israel, et cetera. So we saw an uptick in gold in 2025. The question is, will that continue in 2026? Mike, before we go into the 2026 outlook, anything else that you wanted to comment on the year we just ended?
Yeah, I think our commodity exposure, we consciously shows broader exposure by having clients be invested and allocated to a broad commodity index versus trying to pick which components would do well. Because you know as a year ago, would we have said gold will be up 60%? How do you predict that? Energy prices were lower and detracted, but the broad basket of commodities did pretty well, and it was a very effective diversifier from a risk standpoint. And that's really another reason for that allocation. It's a non-typical allocation for portfolios, and I think it's paid off for clients, and will continue to do so. We're going to remain allocated to that broad index, I think.
Yep. Yeah, well said. So that's a good segue. What are we going to do in 2026 that is different than how portfolios were constructed in 2025, or how does our outlook differ? So we highlight these themes in the letter that accompanies this video. But I would say some of the key things we're thinking about are themes like we've talked about in our 2024 outlook and our 2025 outlook, and now we're talking about again in our 2026 outlook, is artificial intelligence. We think that that is a long-term technological revolution, just like the internet, computers, going back to the combustion engine. We're living through something now that is very special, but also has a lot of uncertainties about how it'll progress in the future. Energy and commodities, we've talked about kind of the tensions there between growth in certain elements of the economy, but then you also have consumers, households, just like Mike, you and I, that are dealing with higher electricity prices. Where does that shake out? Health of the consumer. Again, this relates to, we see households in the United States in particular continue to spend, continue to take vacations, but they're concerned about inflation. They're concerned about the future. And so we'll talk about, the labor market as being kind of jobs being a key input to that enthusiasm. And, could that improve? Could it get worse? That's something that we're watching. Fiscal and monetary policy. This is interest rates. This is how much stimulus the U.S. federal government is pumping into the system, whether either directly through payments to businesses and consumers or through kind of excess deficit spending. And that has ramifications as well with respect to inflation and interest rates. Geopolitics we talked about. We're recording this on the 8th of January, so just a few days after the United States led a military exercise in Venezuela. So you'll see that we've talked about in past videos and past writings that we are seeing maybe an elevation in geopolitical conflicts. We referenced Russia, China, Taiwan, issues in the Middle East. Could that actually get better? Well, I think we're going to touch on that. And then lastly, valuation. Where are we seeing opportunities in the market today? So, Mike, dealer's choice, or I'll let you pick. Where should we start with all this?
Well, I think the AI theme is more than just a certain group of stocks doing well because of building data centers and all that. I think what we're starting to see um, is the productivity uptick more broadly in the economy is starting to show up in productivity numbers. And I think that that bodes well for some of the other themes for the consumer. You have productivity-led wage growth, which also accelerates GDP growth, which helps with the deficit spending. So it's all sort of interrelated. Much of that's interrelated to to this as you mentioned, sort of a structural change in the economy driven by AI. If you step back and say, how and what were you using AI for a year ago versus today? Are we more productive? I can say personally for sure I am, and I
Me
believe
too.
everyone at our firm is. And you just apply that more broadly. And I think that's a driver of accelerating economic growth, which is helps in a number of different fronts. It does come at the cost, I think, in the near term of some parts of the economy or in terms of the labor market, some parts of the labor market being a little weaker in the near term because the technology is changing faster than our structural economic labor force can change and how organizations move more slowly than the technology is. So there's some dislocations that were popping up. But I think in the long run and over a broad sense, it's going to be a driver of economic growth, and that's going to fix a lot of the other issues that we're concerned about
I
over
hope you're
time.
right. Yeah, we wrote about, if you remember, we wrote about artificial intelligence all the way back in 2024
Hmm.
outlook. And part of the thesis at the time was, again, that this is a long-term technological revolution that we're in the early innings of. But part of the thesis was, as you're describing, Mike, that it's not just one sector of the te economy like technology that's going to benefit, that all kind of industries and hopefully individuals' kind of lifestyles will benefit as well. And so we'll see a broad-based increase in productivity, companies that are applying this technology, increasing revenue and earnings and efficiencies. And so we're looking for opportunities now outside of technology stocks and in things like financial services and healthcare and industrial companies that are applying AI to make their businesses better. So yes, we see that as an opportunity. And yeah, hopefully 2026 is the year that that accelerates.
Yeah, I think it's already seems to be happening. And one of the key elements of our positioning has to do with being oriented to a more broad exposure to other assets and other equities beyond the mega tech companies that have done so well over the last few years is a broadening out of participation. And a lot of that's going to be driven by accelerating earnings, that's driven by productivity. And that actually goes outside the US borders. And that, as we focus more on the beneficiaries of AI versus the spenders, that's gonna also bode well for the fundamentals of our non-US company holdings as well.
Right. Yes, I agree. And so hopefully we can continue to see good broad gains, broad-based across assets outside of just large technology companies. So, well, in the interest of time, we don't necessarily need to hit all these, but I think the ones that are probably most important to talk about um, going into 2026, from my perspective at least, would be that continued tension between interest rates and inflation. I think everyone who watches these videos knows, the U.S. Federal Reserve is trying to lower interest rates, and they're getting a lot of encouragement from the administration to do so because that tends to lead to an acceleration in economic growth. If interest rates are lower, more people will go out and borrow and spend. Businesses will do the same. So obviously, we want that, and the administration wants that, but we also don't want higher prices. Consumers, households are, as we said a moment ago, very fatigued by higher prices now in their electric bills, at the grocery store, kind of all basically in many parts of the economy. and where does that tension kind of shake out in 2026? I think we'll continue to see some interest rate cuts, which will help bring down the cost of, mortgages and things. But to me, it seems very likely that we'll continue to see pockets of inflation. Hopefully, maybe less so in the energy markets. I think there's been a real intentionality around energy production, and it sounds like the situation in Venezuela may actually turn on more global oil production. So, energy as an inflationary source could be going in a positive direction in 2026, which we would all notice at the gas pump and in our electric bills. But Mike, what are your thoughts? Where does the Fed go this year? Where does inflation go? And can we kind of thread that needle without another acceleration in costs?
Well, I think a couple of things. Number one, the Fed's 2% inflation target was, you know, extremely low by historical standards if you look at, long-term inflation. And I think that what we could see is, especially with a new Fed chair coming in the coming months, we could see a softening of that target in the sense of not just a hard target of 2%, but say a range of say 2 to 3% or 1.5 to 2.5%. And that will give the Fed some flexibility in terms of rates and also the labor market because they have that dual mandate of low inflation, but also a strong labor market. And those sometimes work and oftentimes work at cross purposes. So it's a challenge that the Fed has, but I think one thing that can happen is just softening that hard target would be helpful. There are also another number of mitigating elements to the inflation story. You mentioned energy prices, and that acts as when gasoline prices come down, that acts as a tax cut for the consumer. Also, one of the drivers over the last few years of inflation was shelter prices, rents,
Mhm.
and we're starting to see some moderation in that as well. But also, the regulatory backdrop is more favorable in the economy, and deregulation is also deflationary or disinflationary. So that is a good backdrop, and I think that's starting to show up in the numbers as well. And so those are sort of elements that I think that, well, like you said, we could see pockets of inflation, but I think overall inflation, will tend to either, I think, kind of stabilize here in this area of 2.5% or so. Maybe come down a little bit, but historically inflation was 2.5 to 3%. So I think we're sort of back to norms
Mhm.
and or getting close to that and heading in a decent direction. And I think that gives some cover for the Fed to focus more on the labor market.
Well, that's very well said. Let's kind of summarize our outlook going into 2026. So we just presented a handful of things we're watching that, as I said, could go in a multitude of different directions. But at the very high level, we still are positive on the economy. We see, as we mentioned, some stress in households and their willingness to spend, or potential stress. And then in the employment market, we're seeing a little bit of softening there, but things seem to have stabilized. But economic growth continues to be relatively resilient. So we're positive on the economy. Financial conditions, as Mike just articulated, could continue to go in a positive direction. We could see inflation hopefully normalize and interest rates continue to come down. So we may even move that dial to a more positive position in future months. And then on the market side, we mentioned in past videos, we really like the large technology companies, the Mag 7 as they're called, that are really helping to build out artificial intelligence infrastructure and both on the hardware side and on the software side. The stocks look somewhat expensive to us. We could make an argument that they earnings, or excuse me, their valuations have actually sort of moved sideways in 2025, and so that actually sets up for a good potential year in 2026. But regardless, we see opportunities in companies across other parts of the market, to smaller U.S. companies that may benefit from AI and applying that to their businesses, foreign companies, as Mike mentioned, and then other parts of the market as well. We touched on the beginning, like things like diversifiers, like commodities and other hedging strategies, hedged equity strategies that benefit portfolios in adverse market environments and may do well in normal market environments as well. So we go into 2026 cautiously optimistic. Mike, what are your thoughts for the year? Anything that you're really kind of what's your North Star for 2026?
I think my North Star is an expectation of moderating returns for the equity market, at least the S&P 500. But I think that comes at the in the process of maybe the biggest names in the market, the mega tech names, sort of re-rating and growing into their valuations a little, and then but that will allow the other parts of the market to outperform. So we could have a lackluster S&P 500 performance, but the value stocks, non-US stocks, and smaller and quality mid cap stocks could do quite well, I think, and that's sort of my base case for the year.
I agree with you, but I'm biased. So thank you everybody for watching, and thank you for your trust in allowing us to manage your wealth. We're excited about meeting with you in 2026. We're excited about what is to come, and we hope you'll watch us again when we do another video next month. Thank you very much.
Thanks a lot, everyone.